Welcome back, traders and investors. We have Tim Melvin on the line, and he has a newsletter, Banking on Profits. It's a monthly report that will provide you with all the information you need to stay ahead of the banking sector and help you identify banks that can multiply your investments over the next 10 years. He's had five banking buyouts in his portfolio over the last year alone. Join Banking on Profits newsletter to get in on the trade of the decade. $47 per year, $50 off the normal price of $97. Go to marketfi.com/bank. Enter the coupon code premarket. Now, Tim, how was that for an introduction?
That was fantastic, man. You guys made me sound important and everything. Thank you. I was just sitting here just cracking up at you guys talking about Amherst Bank being a small, thinly traded bank. I mean, that's a $650 million bank. That's probably the combined market value of my portfolio. Uh, we like the little banks.
I know you. Well, excuse me. I guess I'm wrong. It did trade 161,000 shares on Friday. So
it's got a 70,000 average share volume a day. That's a mega cap in my world.
I stand corrected, Tim. So, do you have any? We have someone that got in on this stock. I don't know. I'd like to check the date and see if it was July 25th because you see if you're on the show that day. What are your thoughts on this stock? Is it something that you take a look at?
Amherst, no, it's maybe 2 years ago when it was trading cheap, but that stock's now at like 1.7 times book. Um, yeah, 1.71. So it's not attractive to an acquirer. Let's say they may be getting ready to buy someone. There's a lot of little banks there in Georgia. There's a lot of attractive little banks in Georgia. So maybe they're getting ready to announce an accretive buy. But yeah, they reported earnings in July, so there's nothing due out of them just right now. So, and I sure don't. I'd be surprised by a takeover offer at 1.7 times book, and I'd short whoever was buying it.
Okay, so if you had some profits in it, you'd just be content with them trading over book value and like to see some more follow through on the upside then.
Yeah, I mean, if I was a trader, I certainly wouldn't be running to sell it. The stock is strong, but I mean, I don't see anything fundamental that would send me out dashing to buy this stock this morning.
Okay, markets at new all-time highs here, and have some of the banking stocks trading up. Goldman Sachs having a nice move this morning. I know that's way, way too big for you to trade, but do you have anything that you might want to bring up to our traders here?
Well, let's just come back for a second and talk about what is going on in the banking industry. I'm going to get a little my big picture hat on here for a second. I was reading the merger markets report over the weekend. The small banks are consolidating. They almost have to, okay, because of regulatory pressures, very low net interest margins, a very competitive environment, and absolutely no organic growth. Now, so far this year alone, we've seen 136 bank deals, guys. 136 takeovers through the first 6 months of the years. It's the highest number since 1998, when we saw a bank merger wave that was starting to peak. This one's just getting going. It's in its first or second inning. More importantly, from our point of view, deal multiples are climbing right now. So you've got these. Last year they were paying 1.19 times book. They're paying 1.45 on average right now. Now, consider the fact that we're buying all of our little bank stocks at 80% of book value or less is our preferred metric. You start to get an idea of exactly how much upside is in this situation. The real bonus is book values are growing for many of these small banks. So I call it double compounding. You're paying a higher multiple of a higher book, and it just keeps going and going and going. So even guys who are making their living trading minute to minute should have some portion of their funds stuck over in these small community banks. It's a tremendous opportunity. I call it the trade of the decade. It's my move to the Keys because the last kid's finally gone off to college trade.
Okay, of those. Question coming here from MSU Mac. Of those 136 takeouts that you talk about, how many were public companies buying other public companies?
Well, a lot of public companies buying private. That's kind of what's going on. But about half were public banks so far this year. Um, There's a lot of little banks out there, guys. There's 800 listed banks in the United States. 90% of those are probably under $1 billion in assets. Not everybody's Citigroup. And a matter of fact, 90% of the deals so far this year have been on banks with less than $1 billion in total assets. Most banks under $1 billion, unless they're an extraordinary franchise, are going to have to sell their bank in the next few years.
Just no way around it.
Not really. No, it's the regulatory costs are too high and they're rising as a percentage. And when you factor in, it's you can't go one town over and open a new branch anymore because the bigger banks already have a branch on every quarter. So very limited growth options. And then you've got low net interest margins right now. And then you've got this just ever increasing wave of regulatory costs eating into the bottom line. Yeah, unless you have an extraordinary local franchise, you may delay, you may kick, you may fight, but you're going to sell your bank.
And is that the trend of the public buying public versus public buying private? Is that pretty much has been the trend, or is that above or below normal?
It's running about normal. We're seeing it maybe a little bit higher on the side of the private bank selling because until the credit crisis, those private banks were a cash machine. Okay, you had a little bank, you weren't filing SEC, you didn't, have as many costs. And it was literally you worked the 9 to 3, you were on the golf course for happy hour by 4, and you were earning 12% returns on equity. It's phenomenal business. That's changed, and it's changed forever. And now a lot of these little banks, these guys are getting older. They're saying, you know what, I'm just done with this. It's not fun anymore. I'm selling. So we got a little tip in that direction, but still plenty of these public banks trading very cheap that are going to get taken over in the next few years.
Okay, you are training our listeners well here. GGB is popping in the chat here with EGFEY. Eurobank, looks like in gaseous essay. Is that?
Yeah, that's my little Greek banks. I've got two of them. I've got that and Alpha Bank, ALBKY, little 20-cent stocks. That's the translation back from the European currency. Guys, these are call options on Europe. If Europe survives, these are $4 or $5 stocks at some point in the next decade. If Europe doesn't survive in its current format, you lost 20 cents.
Okay, good risk reward ratio, right? Okay, good
Yes,
way.
and there's some ungodly smart money in there. Wilbur Ross and Prem Watsa took their money from Bank of Ireland. They're in this deal. Greenblatt's in there, Klarman's in there. Just an enormous amount of smart money has recapitalized these Greek banks. I think I do a pretty good job on the risk reward side of things, and evaluating bank risk. They're better than I am. They're just way smarter than me, and they put significant amounts of money in this bank, both of them, and they didn't do it because they thought they'd lose the money.
We talk a lot about the specific banks and the things that you're doing, but we don't spend a lot of time on how you find your stocks. Your stock screen criteria, and then also your sell process. And I know your sell process is you never sell, and you like to see them get to book value. But could you please just talk about your criteria for entering stocks? And I know you do your homework, and perhaps this will help some of our listeners.
Hey, with non-financial stocks, the criteria are, I don't want to say simple, okay, but they're pretty straightforward. You're looking 85% of book or less most of the time. You're looking for banks that have high current ratios, low debt to equity ratios, financial, a balance sheet that allows you to keep the doors open and the lights on. Trading probably in the lower 25% of the last 3 years price range. If you buy these things right, your sell discipline becomes a lot less important. Now, in financial stocks, it's easy. They're hard to find, but it's easy. 85% of book or less, preferably 80. 85 is where they come onto the radar screen. Okay, then you're looking for non-performing assets, preferably 2% or less of total assets, but we will consider special situation banks where the non-performing assets are higher than that, but have been in steady decline for the last 8 quarters. And then the big thing is capitalization. We want equity to asset ratios of 10 or above. At that level, the bank is in solid shape. They have lots of excess capital. They can pay us dividends. They can buy back stock and do all kinds of fun stuff. So that's really what we're looking for. And then you go in and kind of do the more qualitative analysis of the banks. But I'm big on just, if I just stick to the numbers, I rarely get into serious trouble.
And then your exit strategy.
All right, exit strategy for a non-financial stock is, it's relatively simple. Again, we do a calculation of what we think the company is worth as a fair price in a fair market. If it hits that price, boom, it's gone. Now you get some of these, they'll go right up to fair value, and in 6 months or a year, and they're out of the portfolio. The real big winners that you'll get in your lifetime is the one where the fair value of the company goes up 30% every year, and the stock only goes up 25, and it takes 6 years to catch up. And then you just get these huge, 8, 9 times your original investment returns. You don't get a lot of those in your lifetime, but you only need a few of them. Then on banks, you're pretty close to right on banks about not selling. I tend to wait for the deal. If one of my banks was to climb up to over 2 times book value, I'm going to sit down and have a long talk with myself because there's not much upside left at that point. But barring that, unless management makes some egregious mistake, I'm just not a seller.
And the duration of your trades, I mean, they're long term, right? Days, months, years.
My average holding period's over 4 years.
Really? Wow.
Yeah, it's we call it the private equity mindset. There's a reason private equity funds are the top performing asset class over the last 20 years. It's because they buy stuff cheap and they hold it for a long time.
Okay. And also, we always talk with you about stocks that are on your radar in the market, and I know that it dwindles each time. Now,
Yeah,
where are we at now in your universe? Are we down to zero yet, or you still got
we're
a few kicking
we're we're,
around?
we're not quite at zero. We got a couple small banks we just got done the work on. We're probably going to add those to the bank portfolio.
Okay.
On the non-financial side, not in the U.S., yeah, we're just about at zero. There's some stuff to buy. I already own it, but if you were just coming in with new money, things like Hercules Offshore is still absolutely cheap enough. Core Mines, the silver miner, is cheap enough. Richardson Electronics is cheap enough. But it's a real long list. I think my buy list this week in the regular newsletter, I had like 12 stocks. And in the banking, out of those 800 banks, we had 18 that were buys at this level. So universe is shrinking.
Okay. All right. Tim Melvin here of Market 5 product and deep value investing. Check out his product. You can get a good deal on it here. $47 per year, 50% off the normal price. And you can follow the banking sector with one of the best in the industry. Tim, thanks a lot for coming on. We'll talk to you again soon.
Guys, thanks as always. Have a great day.
Okay.